Hi, my name is Raphael. I'm the founder and CEO of Zendog Labs, and today I want to go through with you the 5 features that investors look for in startups. I'm a former investor, so this is based on how I look at startups. I've also been working with, dozens of startups in the last 12 months looking to raise funds, and have been the VC in residence at fund and investor matchmaking platform. So I've seen a high volume of deals. And in general, this is what I think about it. So there are the 5 features. Shouldn't be terribly surprising for you, but let's go through them one by one and give you a little bit more background information as to why they matter. The first one is the vision of your startup. You ideally want to see a vision that inspires the team and addresses a significant opportunity. Why does that matter? You want a vision that is inspirational because at some point it is going to get tough for you and your team, and you want something that keeps you going because there is intrinsic motivation. And the significant opportunity obviously matters because VCs are looking for outsized returns on every investment that they do, because ultimately only a handful of investments in their portfolio are going to return the entire fund and the multiples that they've promised to their limited partners. So aside from that usually happening, they also need to see in your business that the market that you're in, the upside business case that you're offering them, has that potential. And so they're looking for a vision that inspires you, the team, frankly, also the customers, because that makes it easier to sell and addresses a big opportunity. Second feature that they're looking for is the product. They're looking for a solution that ideally is or will be, depending on the stage of your business, significantly better than what competitors have. The market space is competitive. If you come in with another Me Too business, you may have removed market and technological risk, but you are stuck with, in a red ocean, and it's going to be hard to sell business and win business, frankly, if you don't at least have something that's, that's unique to you. You don't need to be completely different. That can be a tough position to be into because you will have to educate the market. Some investors may be open to that, others may not. But you ideally want to at least have like one angle to your business that is, relevant for paying customers. It's ultimately not about what you think is important, but what customers think it's important. So also have that feedback loop back to your customers and be able to talk about it. So that's feature number 2. Feature number 3 is about growth. You ideally want to see startups having signs of a viable growth engine that can turn $1 into $3 at scale. And every word here is kind of intentionally chosen. Signs of a growth engine, obviously, if you're an earlier stage business, you may not have a growth engine at all. If you're a Series C, you may have signs, and if you're a Series A, you definitely need to be able to demonstrate or start being able to demonstrate that you do have a growth engine. But this differs depending on the stage of your business and your funding ask. What you want to be able to show once you are able to, demonstrate signs of a growth engine that works is that you can turn $1 into $3. And what this essentially comes back to is your customer lifetime value relative to your customer acquisition cost. I should say customer acquisition and retention cost, right? Just acquisition doesn't really cut it. You want to keep people too. And if that ratio is in balance, it means that you have good retention in your business. It means that you have upsell, cross-sell, resell opportunities, that you keep customers, that they're sticky. It's true both on the consumer and on the B2B side. And ultimately, I, as an investor, if you can demonstrate to me that you can turn 1 into 3, then you're essentially a money printing machine for me. And so why wouldn't I give you 10 more or 20 more or whatever more millions that you need? Now, at scale, that is intentionally chosen as well. At scale means that on average, and I'm sure you have experienced this too, growth engines become more inefficient as you start making more revenue, as you generate more leads, whatever it is, by reasons that are as simple as your Facebook ad spend could be going up if you're trying to go from a $50 ad spend per day to $500 to $5,000. It likely is going to go up just because the total addressable market at some point is going to have been targeted. And that makes it more inefficient. There are other reasons, of course, too. But that's the growth feature. Feature number 4 is on your team. And team certainly matters too, but relative to growth and product, ultimately, if you're able to show that you are on a hockey stick and you're on the good part of the hockey stick, Nothing else really matters. But team is important too, and you want to have a complete co-founding team. Solo founders can do it, especially as they make more progress. They're essentially telling investors, hey, by the way, don't judge me on how many team members I have, judge me on my actual progress. And clearly it's working. So at that stage, you start to have a better pitch. But if you're early on and you're just getting started and you haven't started a business before and you're solo, that's going to create headwinds for you. So investors do look for co-founding teams. And then ultimately all comes down to the fact that startups are hard to build and usually need complementary skills. Individuals can learn most of those skills on a superficial level and then hire the appropriate people to do so. But it slows you down. It means you have to spend on HR, and neither of those two things are necessarily desirable. And then appropriately incentivized means that your co-founders should all have a stake in the business that keeps them interested in the business. There are two scenarios where this could not work out, at least at the top of my mind. One, you're a corporate spin-off, or you have been built in as part of a venture incubator or company builder program, whatever it is, and you came out of this program or spin-off with, let's say, a stake somewhere between 5 to 10% as the CEO. For many investors, that will be a no-go just because you don't have skin in the game and you won't be incentivized to push through as much as someone that owns 50, 60, 70% in the early stages of the business. Sure, ultimately your stake is going to go down over time, but it's really only at that level once you're at a Series C and D, maybe even your IPO, post-IPO, you could still own up to 10 or 15%, depending on how you structured your deals thus far. I mean, just look at some of the publicly available comparables here. The second scenario is that you are a CEO that has started on his own or her own, and then along the way brought on team members, and you're giving your team members, because they're not in some sense, quote unquote, co-founders, they've come in later, you're giving them, let's say, 1 to 5%. On average, that's a better scenario than being a spin-off, but it still means that ultimately you're on your own in this. And many times that's the case, right? Many times one of the co-founders will feel more strongly about the business and has convinced the others to join. And once it gets tough, the original founder or inventor of the idea to some degree will stay incentivized and the others will drop off. But ideally, you have ways of incentivizing them through equity. And that doesn't mean you don't want to vest your equity. You will be vested, including yourself, and you will be reset on that vesting schedule most likely when you raise capital. But the basic still applies. Team is important. You want to have a complete co-founding team and have them be appropriately incentivized. And then last one here is your funding ask. It's it has two components. It's that you have a reasonable ask in terms of the cash that you're asking for and the valuation that you're proposing. If it's a price round, if it's a safe note or a convertible note, it's a little different. Then you want to be thinking about your discount and valuation cap, and those should also be roughly in line. But the ask should be reasonable on average, and then you should have an efficient use of proceeds. The interpretation of efficient use of proceeds will depend a little bit on the macroeconomic environment. I'm recording this video in 2023 where we're going through a period of high inflation and high interest rates, which makes capital more scarce, which means you need to be even sharper with your use of proceeds, adjust your funding ask, potentially probably adjust your proposed valuation. And this is probably the best time if we take a step back to start a business, because once the conditions loosen up again, you are in for up rounds rather than what people are facing right now is either flat or even down rounds. You don't want those. Either way, efficient use of proceeds is I'm going to deploy, let's say, 30% into growth, 30% into product, 20% into whatever else your business needs to, brings us to 80%, and then another 20% for legal, overhead, whatever. And ideally, don't stay just at the 30-30-20-20 level. And by the way, this is not my general recommendation for how you should structure the use of proceeds. That really depends on your financial model and where you see operating expenses and capital expenses going to. But what I was trying to say is that you shouldn't stay at that high level. You should be at that high level and then provide more detail on what you will achieve with that capital. So the funding ask slide really has a couple of things that go onto it, and you should definitely have it in your pitch deck. It's the ask, it's the instrument, it's your use of proceeds by expense category, and then what you will achieve with it. If you can say, hey, I'm going to deploy 30% of growth, and I'm going to hit 1 or 2 million in ARR, that's fantastic. So, taking a step back, vision, product, growth, team, funding are the 5 features that matter to investors as they look at your startup. We went through what each means and how to think of it. Do address all of these points in your elevator pitch, in your pitch deck. As a matter of fact, you can structure your elevator pitch using these 5 bullet points. You can talk about, hey, the vision of my business is XYZ. I'm building product ABC. We have seen growth XYZ. My team is me, my co-founders, and someone else, and we're raising XYZ to do ABC. That's a pretty good elevator pitch on average. And then final note before I conclude this video, the more money you're asking for, the higher the bar will be that you need to meet with regard to these 5 features. So if you are a pre-seed business, you don't need a viable growth engine. You likely don't even need much to show in terms of product, and it will be heavily dependent on your vision, team, and funding ask. And whatever else you are able to show, of course, the more you're able to show, the better for you. The moment you go into a Series A, growth will become much more important because on average, a Series A is a growth round, and you're raising that capital to double down on growth. So I, as an investor, want to see that the fundamentals are there. At least for me, don't try to get a Series A from me if you aren't able to talk to me about customer lifetime value, customer acquisition cost, your go-to-market motion, and how you're going to grow your sales and marketing team going forward. Then as you're hitting your Series B and most certainly C, it becomes much more like a private equity investment that is very data-driven rather than a venture capital narrative-driven investment where you look at margins, you look at cash flows potentially, certainly revenue. Ultimately, a Series C starts to be a prep round for an IPO, right? So you want to see the maturity in the business to be able to pull that off in, let's say, 12 to 18 months. And then on top of that, what you also have as important factors is market conditions, location, vertical, and quite frankly, investor preferences too. It's really hard to get it right for everyone, so you have to shoot for the average or the median, whichever you prefer. One common theme that you would, for instance, see is around location, where US startups are able to raise a seed round, even a multi-million seed round off of just a pitch deck, especially if they have a very strong narrative and team. In Europe, that's almost impossible. If you want a seed, you will have to have some signs of product market fit, which is usually seen as somewhere between 150 to 250K in annual revenue. Could be more than that, depending on individual investor preferences. And as you're moving into emerging and then frontier markets, it is just getting more and more relevant, this problem, because capital becomes more expensive to some degree for these regions. It's unfortunate, but it's reality, and you cannot bend the rules of physics. You just have to handle them and merge and form them. All right, that's it. As mentioned, I'm Raphael, founder and CEO of Zendog Labs. Within venture capital, what we do is just help startups raise. What we focus on is more on the preparation phase. So we get your pitch deck ready. We help you think through fundraising strategy, and we certainly also have partners that can help you get introductions. If you have questions about these things, feel free to reach out to me through the channels that I've linked. Perfect. Have a great day. Bye-bye.